Hey guys, it's Rudy coming at you live from Florida, and I'm still in catch-up mode, trying to sort of get up to date with all the things I've missed and all the comments that I hadn't responded to for a while I've been traveling and while I've been away. But I'm making progress, as you can tell, because I've been able to upload quite a few videos this past week, and of course, you guys are awesome. So the interaction on the channel and the comments and communication and stock tips and ideas that you come up with are great. So I want to sort of touch on some of the most recent conversations that we had, and maybe just provide some context and comment and share some uh, content that was provided by the people on the channel. So it should be great to kind of see what the people are thinking and what they're into. So in the first place, what I want to show you here is just sort of my general macro thesis from an energy investment point of view. So MDPI, they publish white papers and draw really interesting graphs like the one that I'm showing you on the screen right here. The reason for this big red circle here is that the colors, if you match them down at the with the legend at the bottom of the screen, you'll see the big brown strip is oil, and then coal, and then the green part is gas, and then we go into nuclear, and then after that I'm not really interested, even though the next big blob is hydro. I mean, hydroelectricity is a great potential utility and energy investment that you can consider. But for me, I really want to play in the sandbox where most of the money is made and where most of the demand is created every single day. We are using energy, and the bulk of the energy that we are consuming, just as people all across the planet, are oil, coal, gas, and nuclear. So that's kind of my sandbox, and that's where I prefer to play, and also where I prefer to allocate my capital when I'm allocating cash for investment. So let's take a look here at some of the content and comments and questions from the channel. So Jerry Brooks said, let's hear your thoughts on Oxy. So there's one I haven't spoken about for quite some time. Mr. Oxy doesn't really talk about Oxy anymore. Okay, Jerry, at least we'll give Oxy an honorable mention in this particular video. Allure said, how about Petrobras and Ecopetrol? Now, of course, I've covered Petrobras quite a number of times before, not only why I'm selling Petrobras, but also why I'm buying Petrobras and why I was holding Petrobras. So I've done sort of a whole 360 on Petrobras, and I've talked about Ecopetrol and compared it to Petrobras a couple of times as well. And if you look in the library, you'll also find a video on Equinor. So I have spoken about those before, but that's already 4. And then Captain Black said, Rudy, any thoughts on Shell? Well, Shell to me is kind of like it's kind of like Exxon or Chevron, Mr. Captain Black. I don't really want to dive too deep into Shell because it's one of those stocks that I'm quite comfortable just saying, if you want to buy it, just buy it and hold it in your portfolio and you'll be okay. You know, it's not really one that's making too many waves, even though it's had a good year over the past 1 year period or so. It's done pretty good and better than many of the others. I don't really want to dive into Shell, not in this particular video, but maybe I'll do it at a later stage, comparing it to some others. Let's take a look here at our friend Steve from Iowa. So Steve Allen says, and I've just highlighted some of his comments here. You can read his entire comment on the site on one of the previous videos. He says, I would focus on companies that produce far more liquids than gas. His thesis behind that is, as you know, there is a pipeline bottleneck in the Permian. The reason many producers there sell their natural gas at a loss. Oxy is in a great position there because 1, they have great rock, and 2, they have WES. Well, WES we could actually almost cover on its own, but yeah, about 50% of WES is owned by Oxy. Canadians are looking dirt cheap right now, so I've talked about a couple of Canadian stocks. In fact, in the video just prior to this one, I was talking about Enbridge, which is my boringest stock in my portfolio. I've also talked a little bit about Canadian natural resources in a couple of videos this past week. And Steve says he is buying SU and CVE, which is Suncor and Cenovus. Cenovus Energy is a good pickup for many people, and Suncor is sort of like my Enbridge. You know, it's like one of those steady eddies. You can just hold it, tuck it away, and keep it like sort of forever, right? Like Warren Buffett said, what's the best holding period for an equity? Forever. So these two, so Steve is saying these two, Suncor and Sanofi, as well as Oxy, will be big winners. So Steve, I hope for your sake you're right. Thank you for the content and the comment. This is great feedback. So let's look at these five that I'm going to compare here, right? So I did mention Canadian Natural Resources, and then we got Ecopetrol, Equinor, Occidental Petroleum, and Petrobras. I put them in alphabetical order so we can maintain the same order throughout these slides. They're not all the same, so it's not fair to really line them up against each other because they're not necessarily really peers, but they are the same in some respects, right? So in the first place, they're all sort of in oil and related markets. They all trade on the New York Stock Exchange, so they're relatively easy to buy, but all things are not equal even there because you'll see at the bottom of the screen here, Ecopetrol, Equinor, and Petrobras are ADRs, and ADR is an American Depository Receipt. For people who live in the United States, you're not actually buying the shares, you're buying ADRs. So an ADR is like a note which sort of matches the par value of one share, but you're not actually buying the shares on the exchange, you're buying ADRs. The other two, Canadian Natural Resources and Occidental, you can just buy on the New York Stock Exchange, which is where they are both traded. The industries, as I said, are not the same. They're slightly different. So if we look at Canadian Natural Resources, it's oil. It's see this little dollar here is Canadian. Exploration and products, so EMP. Emerging markets integrated, that's Ecopetrol. Um, Emerging markets integrated is also Petrobras in Brazil. And then Equinor is refining and marketing oil. And Oxy is US integrated. So as I said, they are the same, but not exactly the same, and they're not necessarily peers one with the other. Looking at the technicals here for the technical geeks amongst us, the 20-day raw stochastic, if it's less than 20%, it's hopelessly oversold. And you can see pretty much all of them are hopelessly oversold. Ecopetrol is just touching on 20%. The others, 16%. 20-day raw stochastic on Canadian Natural Resources, 13 on Equinor, 18.5 on Occidental. Petrobras are only at 12. You can almost be as bold as to say, I'm going to throw some darts at these and buy the first two that it lands on. There are a couple. I mean, like Petrobras, I've said many, many times before, is the cheapest super major that you can buy on the international stage, but many, many problems and lots of risk as well, right? You just need to be mindful of that. Ratios, the PE ratios, the price earnings ratio is a good indicator for us. Oxy seems to be the most expensive. We don't want to really start a new position when it's above sort of 15, 16 or so at this time. Canadian Natural Resources, 12, it's okay. But look at the others, like super cheap in theory, right? Sometimes the price earnings ratio is very, very low for the wrong reasons. And you need to do a little bit of a more deep dive or better due diligence to make sure that you understand exactly what's going on. But Ecopetrol at 4.6 and Equinor at 8 and Petrobras at under 4 looks to be ridiculously cheap when you look at the price earnings ratio as a guideline. Market cap, so market capitalization or valuation, in case you've forgotten, is the total number of shares multiplied by the current share price. That gives you the valuation or capitalization of the current company. And what I'm looking at here is annual sales, right? So the annual sales, 26 billion compared to 73 billion in market cap, right? So you can do the math on that one. You can say sort of around 3 times or thereabouts. But look at this as an outlier. So Ecopetrol is generating $171 billion in sales and the market cap is only 21 billion comparatively, right? I always look for outliers. Here's another one. So Equinor, $107 billion in sales and a market cap or valuation of only 76 billion. The others are sort of more in line or more normal, right? So Oxy is generating about 28 billion in sales, market cap around 53. It's kind of normal, sort of average. And even Petrobras, 102 billion in sales with a market cap currently of around 94. It's sort of, if you look at it from a price to book point of view, it's sort of fair value, right? Or thereabouts. They all have positive earnings, which is a good thing. The last earnings dates, so the latest earnings date, sorry, coming up soon, August 1st, 13th, 7/24. So just a couple of days ago, August 7th, August 1st, right? So 4 of them are about to report in the next couple of weeks or so. So we can look out for those. And then if we look at it on a picture for the past 1 year, you can see Canadian Natural Resources has been an outlier and it's outperformed the other two quite nicely. But there's a reason why, because you had this big spike here a few months ago, whilst the others, in terms of their trajectory, were sort of the same, right? And if you look at them collectively, you can see that they're all kind of trending negative, and the outlier here is Canadian natural resources, right? So maybe when there's a little bit of a pullback in Canadian natural, you can pick up some of those. The other ones, you can nibble on them as you go, but I wouldn't necessarily jump in boots and all on any of these necessarily right now, right? So the graph always tells an interesting story, but there was an interesting sort of series of events there, which is unusual and not the same for everyone. So let's look at sort of at a market snapshot very quickly for all five of these stocks, right? So you can buy Canadian natural resources. This is in US dollars for about $34. It's up 14% over the past year. And right at the bottom in the middle, you can see it pays a dividend of 4.5%. So if you take your 4% dividend and your 14% stock appreciation over the last year, you're up about 18. You're probably happy, right? In April, just a couple of months ago, it was trading at 41. So there's some upside here. So maybe it's pulled back enough to at least put it on your watch list and maybe even start nibbling and opening a position in Canadian natural resources. I'm not sure yet, but I will tell you when I do that, because it is on my watch list, and I have been sort of toying with the idea of maybe taking some profit from Enbridge and moving it into Canadian natural resources. But for now, I like Enbridge because it's paid me that 7.5% dividend, whereas Canadian natural resources only 4%, right? So before I allocate capital, I want to be sure that I'm trying to get in sort of at the right time. Having said that, though, trying to time the market is not as good as time in the market. So it's better to buy and hold for a longer period, unless you're day trading and then you're a different animal, and you probably wouldn't be listening to me anyway. Eco Petrol you can buy for about $10 now. I've covered eco petrol in a couple of videos over the past few years, and from memory, I can tell you that in almost every instance I've made a video on eco petrol, I've said you can buy eco petrol for about $10. Well, I know this is up and down over the past 1 year, but it's pretty flat, like averaging around $10. It's always been there or thereabouts. The highest it's been in the past few months or so over the last year was in April. It actually hit 12.89, so almost $13 for a while now. It's back at $10.70. If you don't mind the risk of an emerging market stock and you like the extraordinary high dividend, look at the right at the bottom in the middle there, right? It's currently yielding 31.5%. Of course, remember they could cut it at any time, like Petrobras did. But then, even if they cut it in half, you still have 15, 16. So it's not too bad, right? But do keep in mind, if you're buying into an emerging market stock, it carries a lot of risk, more risk than, for instance, buying something like Shell or Total or BP or Exxon or Chevron or whatever the case might be. Equinor, a Norwegian company, you can currently buy it for around $26. It's come off its high, which is what now, almost a year ago. It was nearly at $35. They cut the dividend, which impacted the stock negatively. But over the past year, it's down now about 17%, but it pays a dividend of about 13%. So arguably, it's sort of a bit of a wash. I'm not sure if Equinor right now is worth opening a position into. I think that one requires a little bit more due diligence just on its own. If you're going to buy Equinor, you probably want to do a little deeper dive than just watching this video, and maybe look at the fundamentals and look at the balance sheet and compare some of those assets, liabilities, and owner's equity. Oxy, well, I'm comfortable holding Oxy, but the only reason why I'm comfortable holding Oxy is because I'm very fortunate in that my cost basis is around $10, right? So I've got a 6x return on my investment here. This thing is super volatile. Obviously, whenever the price of crude moves 1%, Oxy just moves 3% that same day, up or down. So you never know with Oxy. It just bounces up and down and all around. Just a couple of months ago, it was at almost $70. Now it's back at $60. It doesn't pay a good dividend at all. So you're not buying Oxy for its dividend. It's currently yielding 1.45, so 1.5%. But as I said, my cost base is $10. So because I've got a 6x on my cost basis, um, in terms of stock appreciation, that dividend that's currently yielding 1.5% for me yields about 7%. So my Occidental is almost the same as my Enbridge. It just sits in my account, effectively earning me dividends, because I don't see too much upside from where it is right now. It might go back to 70. It could also pull back to under 60. And who knows, if it does that, then maybe Berkshire Hathaway buys some more. I'm not too sure. I would just hold it right now. I wouldn't be buying Oxy at this price. I did notice that they are issuing Notes again, so they've got some senior notes, a whole variety of different notes that pay a different return on investment, so 5.2 up to 6, depending on when the senior notes expire or become due. 2054, so so 20 years from now, 6%. It's not a bad note to buy. I'd rather have the stock because I'd prefer the stock appreciation plus the dividends as opposed to just holding the notes. Petrobras, 1450. So I actually hold PBR.A, which is the preferreds. So I don't have PBR, which is this one. The preferreds trade a little lower in terms of price, and the dividend yield is about the same. So as I just mentioned with I'm sorry, Ecopetrol, they could cut the dividend anytime, but if they cut it in half, you're still making 15, 16% on your dividend. So Petrobras did cut the dividend and they withheld some dividends, but we still have a dividend yield of almost 20%, so 19%, right? So over the past year, it's flat. In other words, let's call this zero. So your entire appreciation on your account has come from dividends, which is almost 20%. So even if you are flat on Petrobras and you've been in the position for about a year, you're still up arguably about 20% on dividends, even though not all the dividends have been paid yet. But it's paying quite a juicy dividend, so I'm okay to just hold Petrobras here. And I think we will get some stock appreciation here. I'm okay to hold, so far there hasn't really been a buy that jumped at me, but if you were willing to accommodate the risk, you could definitely go and look at Ecopetrol and Petrobras as potential buys. Equinor maybe needs a little bit of more due diligence. And then for the captain, a quick snapshot here, just looking at Shell. So currently you can buy it for about $72. It's been a great performer. It's up 15% per this so far in the past year. And in addition to that, pays a dividend right at the bottom in the middle of 3.5, right? So if you add the 3.5 to the 15, you're up to about 18 and a bit in terms of your return on investment, stock appreciation plus dividends. If you can reinvest the dividends, you've even been buying more Shell. So that compounds and compounds even quicker. It had a high, in May, so just a couple of months ago now, of $74, and it's currently trading at $72. So it's pretty much trading near its 52-week high anyway. So maybe if you want to get into a position on Shell, you want to wait for a bit of a pullback. Although I'm not too sure a pullback is coming anytime soon for Shell. This company is a great company. And it's like I said when at the beginning of the video, when I mentioned you could probably just buy Shell and stick it in your account and just keep it. Let's take a look quickly at consumption, right? So the reason for the red block here is India and Japan are in the top 5 in terms of daily oil consumption, but they produce virtually nothing, right? So the companies and that I just covered and spoke about are located respectively in the United States. So Occidental Petroleum, Brazil, Petrobras, Canada is Canadian Natural, Colombia is Ecopetrol, Norway is Equinor. So Oxy is in the US, which is the largest consumer, and then Petrobras 7, Canada number 9, Colombia is number 40 on the list of consumers, and Norway only at 55, so they don't consume too much in terms of what they produce, which is a great position to be in, because for those two countries or companies, Ecopetrol and Equinor, they are basically in a country that consumes significantly less than what they're producing, which means they can export a lot, which helps their GDP. How about if we look at the producers, right? So here you see some new entrants compared to the consumers on the other side of the ledger, and especially Iraq, United Emirates, Iran, and Kuwait. These guys produce quite a lot. You can see the millions of barrels per day. They're all running at about 4%. So collectively, they produce quite a lot, but consume, relatively speaking, very little. On the other hand, as I mentioned, India and Japan consume about 10% of global production, but they don't even feature sort of in the top list. At the bottom, though, a nice little interesting tidbit of statistical information for you: world total 101 million barrels per day. And where's it going, right? So the IEA says oil demand is growing at a slower pace, and at the same time they say total oil capacity will rise by 6 million barrels per day to 113.8 million barrels per day by 2030, a staggering 8 million barrels per day above the projected global demand of 105.4 million barrels per day, which they had before. So the reason why that is interesting is because despite all the trillions of dollars that's spent on solar and wind and biomass and things like that, oil production just keeps chugging along and gets bigger and bigger and bigger. So just for fun, I'll leave you with this. What can you make from 1 barrel of oil? Well, you can make quite a lot of stuff. You can make distillate fuel that will drive a large truck approximately 40 miles, or a car about 280 miles, or you can generate about 70 kilowatt hours. And you can make asphalt, which is tar for patching roofs and streets, with just 1 barrel of oil. It's quite an interesting graphic, which is from Visual Capitalist up here on the top left. So you can look it up yourself if you like on the internet. And if you have some leftover oil, which you will, then you still have enough in your barrel to make 39 polyester shirts, so that you can actually wear a shirt instead of walking around shirtless. And at the same time, you can do some exercise, because you can make yourself some rubber balls. You can keep your house clean by making some plastic dustpans. And at the very least, if you don't want to do any of those, you can make yourself a comb. You can make 750 pocket combs, so that at least you can keep your hair neat from your 1 barrel of oil. That's what 1 barrel of oil produces. We consume oil on a daily basis. We need it for many, many, many things, including pretty much everything that you see behind me contains some elements of oil. And as long as that demand is there, which is going to be for generations to come, I'm quite happy to park and allocate some of my cash, including cash awaiting investments, into energy stocks, because that's where the money is made if you are patient and willing to buy and hold, and not try and time the market and go in and out of positions on a regular basis. I hope this helps at least somebody. Take care. I look forward to your comments, and we'll chat soon. Bye-bye.